So if you haven't been to a Ticker Talk before, we do these a couple times a quarter to really kind of introduce either industry experts in marketing or operations, because it's either like, kind of who we are, what we do type of deal. And Gamal, who is a beast when it comes to e-commerce, and I'll kind of let you speak a little bit about it. I put it in the format and all of that, so people have like an idea of what you're doing and what you're about. And I figured today's conversation, although Gamal, I mean, you're welcome to give a little bit more background, would be more on like exiting and finding brokers and all of that stuff, and kind of the trials and tribulations of what it looks like when you are in the process of selling a company. Just all of our past clients who have sold, they're always like, we're almost at, it's almost like selling a house. They're like, we're almost at closing date. We're almost at closing date, right? And it's like this time where, there's like hope and anxiety or having a baby inside of your entrails. So, yes, it is Friday afternoon. And Gamal, so I figured super laid back group here, just being kind of like, I mean, I don't have to tell you this, right? Like, just the good, the bad, and the ugly. Give it to us all.
I got you.
So I'll let you kind of, talk for a little bit. I'll ask you a couple questions, and then I'll open it up to the group.
All right, that sounds fair. And very familiar with Mark, college buddy. How are you doing, brother? Mark
Doing
actually
awesome.
helped me gather my thoughts more clear around what I'm offering now. Spent a bunch of time with you and Juliana. Itai, Alex, Ginsburg, 9000. What do you guys do?
I'll start first. I got a digital agency. Well, we do traditional too, but we're primarily a digital agency out of fabulous Las Vegas, Nevada.
Sweet.
And actually, I helped Juliana on some of her deep dives. I'm a scale time team member.
Very nice.
And then I run a video production company.
The background makes a lot of sense for that. Dope. All right, so real quickly about me. I'm Jamaican, as if you know Mark, he is as well. So gunshots. Pay the country a visit pretty soon. We love the tourism, and moved to the States as a young kid. Kind of one of those people who've always been entrepreneurial. My grandfather was, so that was my kind of role model in this. And did a bunch of things in my 20s. Was successful in corporate, but hated it, and got into this paid advertising thing. Blew up a whole bunch of other people's brands. I guess I would imagine Ginsburg 9000. What is your name, by the way, Ginsburg 9000?
Oh, sorry, it's Jeremy. Sorry,
Jeremy. Okay, cool. A little easier to digest than Ginsburg 9000 every time. Jeremy. So much similar to you. And I was like, man, I'm making all these people money. I need to make my own money. So in between there, I spent some time in mergers and acquisitions, doing this thing called leverage buyouts, where you would essentially buy companies for fractions of the cost of the company out of pocket, using leverage, i.e. banknotes, or equity from private investors. And I got mentored by a guy for a few years, and I had a great understanding of how that worked. During that time, I helped him kind of deploy about $50 million into a variety of companies. So I had that experience, and I had the experience marketing a brand. So I decided to make my own brand. And we went from start to about 60K a month in our first 90 days. And then we kept scaling, kept running into issues, nearly had to shut the company down. We lost our ad account, which we depended heavily on, and was about 2 months away from bankruptcy, essentially. Having had all this success, I realized I was running a Ponzi scheme in the form of an e-commerce business where, as long as this month revenue kept coming in, it kind of overshadowed or hid the problems of the bad decisions I've made previously. And in that moment, I decided to make my business more prepared to sell. And so that's what I want to talk to you about, that experience from that moment, 2 months away from bankruptcy, to scaling multiple millions and then getting acquired in about 2 years from that kind of aha moment. Make sense? Sounds good? Cool. So
Yeah, absolutely.
one of the biggest things in which I'm imagining scale time is helping you with, but one of the biggest things is transferability. That's a big bucket for the buying process. The 4 buckets are like transferability, risks, growth potential, and documentation. So transferability, risk, growth, documentation.
I was going to
One
say,
more
can you
time.
say it again, but then you were. Yeah.
Yeah, one more time.
Yeah. And oh, sorry, Gamal, I didn't mean to cut you off. And just so you guys know, this will be put into our Tinker Talks in Kajabi, so you can have this in the future with the transcript and all that jazz. So I love that you take notes, and in the interest of time, we will not make Gamal repeat himself 20 million times. So, all right.
So the 2 main things I want to spend time on is transferability and essentially this other bucket that's kind of like risk/value. So transferability, the thing that I realized is I was involved with every freaking decision. And your business isn't a transferable asset if the things that generate revenue for the business can't transfer with it. So oftentimes you think about documentation and transferability, you think about like the support team, like the product deliverability, the support, but you don't realize how much of your time is spent on, even if you're not running the ads, you're coming up with a strategy for the ads or the marketing funnel or the product development roadmap. And a lot of me was tied up in that. And what happened and where we came to a halt was I was distracted by something and I took my eyes off of this piece, and then a rug got pulled from under me and I was left realizing that I never had a contingency plan for either a team member or an external like agency to help me constantly develop this piece. So as you think through what you're doing now as agency owners, who else on your team is involved with not only just operational decisions and day-to-day activities, but revenue generating activities, and not just sales calls, but the idea of how to position your program, product, services, your business, who's coming up with the strategy and the ideas to create the creatives for your ads, who's helping out with the copy of your landing pages. All of these things are things that you eventually want to get another brain involved with, or document the process to outsource that completely to another party. Because if you don't have that in place, the value of your business is going to be significantly less if it requires you to be able to do all that stuff. Make sense?
Yeah, absolutely. And when you were in the process of scaling the last business, let's say that, what were the biggest challenges in getting, well, I think like in sort of that transfer of decision making and leadership to others? Like, you know, I mean, a lot of our people will be like, oh crap, I'm the only one that can still do X. And, you know, and it goes from execution to QA to then decision making. And then last pieces are sort of like strategy and vision, right? So I'm kind of curious to know how you got up that ladder of transferring that level of leadership of the business.
Good point. Because at the time, it was maybe 2 full-time folks, a bunch of part-time folks, some agencies. What I realized was I was growing too fast without clear vision and mission. So I pulled everything back, and because everyone kind of had different parts of what they thought was happening, and I realized in talking to everyone individually that there was no clarity from myself. So we scaled everything back, and I kind of went back to the roots. I read all our reviews, both negative and positive, and got to the core of what our customers were interested in using our product for. And I went back to create a simple 1-page kind of mission vision statement of who we wanted to be, who we wanted to help, and how we wanted to help them. So I like to think of that as like 3 Ps: person, pain, promise. It's kind of a simple way of thinking about these 3 sentences. Who's my company serving? In what way are we serving them? And how can we make a promise that we can alleviate or improve that pain or problem that they have in their world? And I got clarity around who we wanted to be and what we wanted to do it for. And then I made that document clear to all the other hires who we hired. And I'm like, hey, look, we're not talking about money. This is what we're trying to do. And in doing so, money would come. And so clarity around that was one thing. And then I needed to get a good right-hand person. Fortunately for me, that right-hand person was my wife. She saw me struggling with this, and she was very operationally driven. I am like a bunch of shiny objects, a bunch of cool marketing ideas, relationship builder, big vision person, but managing team, project management, seeing things through and digging in the details, not my strong suit. So I wanted to get someone who complemented me in an operator role. And fortunately for me, my wife was doing that in corporate, and she left a 6-figure job to help execute this vision. But if you don't have a wife or significant other who has that skill sets, I think that's definitely the first place to start if you are a founder who shares my similar strengths. And then she was able to kind of bring that home and manage all the future employees. And the other thing we did was we had weekly and daily stand-ups depending on your hierarchy in the company. So kind of first level under us, I guess we would be the executives, and first level under us for our company structure were managers. And then they kind of had day-to-day responsibilities for the team. So the managers, we would have daily stand-ups, real quickly, what you worked on yesterday, what your 1 or 2 things you're working on today. And then at the end, it would be like, all right, what issues do you have that we wanted the whole kind of executive or management team to talk through? And in doing that, it just kind of allowed us to make sure that our mission vision were top of mind when we were making these decisions, or when our managers were making these decisions. And it helped us to be on the same page as things kind of continue to scale.
Yeah. Alex, you had a question?
I'm curious what your so all this stuff is like very relevant to where we're at right now. As I kind of think about org structure of our company, I'm curious like what your team looked like from you're talking about like daily meetings with your managers, weekly meetings with other team members. I mean, just so we can kind of picture what the business looked like.
Yeah, I can share it on this cool little tool here. This is super simple for our company structure. Juliana said no presentations, but
we do like pictures.
Okay. You guys can see this? All right. I didn't create this at the time on this cool tool, but I got inspiration from Sam to document it in one thing like this. So I got down to what I thought were our 6 key roles, essentially like what was important to moving our business forward and nothing else. So I narrowed it down to these 6 roles. I needed support. This is me, my wife. This were kind of on the marketing and design side, and this fell more on the operation side. So my two biggest roles that I needed to offload is around managing the marketing, so paid advertising, owned media, and just the ideas and strategy that I did to generate revenue. And then around the creative direction on the photo shoots and the content that I was creating to tell the vision and story of our brand. Those are 2 elements I knew I needed to offshore if we were going to be extremely transferable. And on the operation side, she managed the day-to-day ops, warehouse, SOPs, teams, etc. And we needed to have one person who led our customer support team. And we eventually had like 1 or 2 kind of smaller people under her. And she was based in the Philippines, by the way, and like the whole team was. We've tried outsourcing to Jamaica and the Philippines and having someone US based, but ultimately we settled on Philippines for all our team. And then someone in the warehouse that led the other part-time associates. So for us, this org structure made sense. And for a daily stand-up, we would have daily stand-up with myself, my wife, and the operations people. And on a weekly stand-up, we would incorporate the marketing and content people, since the operations were more day-to-day and having issues come up more regularly. So we needed to stay in touch a little bit more often. So this was like super simple. It may not be the case for you.
Cool. I have some specific questions about HR stuff, but I can ask at the end.
Okay, cool.
Gamal, when you were starting, and I don't know, maybe this is a question for your wife, but when you guys were starting, you know, like when you had that breaking point of like, oh crap, we need to like really get organized. What did that mean in terms of like, did you do anything beyond like get more revenue, right? Because obviously, like it sounded like you were cash constrained. Were there any other pieces that were operational that you're like, ooh, we need to kind of work on that as well?
Yeah, so the problem was we were too focused on revenue. So revenue was good. We were doing like 6 figures monthly, but we were not focused as much as profit. We were just focusing on scaling. And so the mental shift from revenue as the main KPIs to profit being the main KPIs was critical, just operationally how we did things. And we looked to cut back expenses and also to grow our margins. So a big thing that we did was just simply increased our cost, our cost price for our products. And e-com is a little different because it has lower margins and it has like it's effectively a negative cash flow cycle. What that means is if we want to sell, in our case, we sold Beard oil, we would have to buy Beard oil today and it would take 6 weeks to get there. And then sometime around there, we would start promoting it. And little by little, we would start recouping our money from the investment we made 6 weeks ago. So if we want to double our revenue in 6 months, we got to use today's already thin profit to buy more, twice what we can support today, that when we get in 6 weeks, the demand will catch up. So what we're doing is growing too fast. And that gap grew further and further away. So when the thing that allowed us to generate revenue kind of came from under us, we realized that we're stuck with all this shit from like bad decisions we made previously. So thinking about how we bought product and how we launched products to maximize our cash flow was a big thing that we had to rethink in order to scale better the next time, so that we had some wiggle room. And what most people don't realize is that if you increase your top line prices by like 10%, that does not equal a 10% increase in profit percentage wise. How the math works, it's like a 10% pop was probably like a 23 to 25% increase in bottom line. Just because if you're doing like $100 in revenue and the cost to sell that thing is like 20 bucks, you're left with $80 left. And then all your operational costs are, let's say, 60 bucks. 60 from 80, you're left with $20. That's a 20% margin on $100 in revenue. But if you go from $100 to $120 to sell that product, your operational costs stay the same. Your cost to acquire the product stay the same. So all of that difference that you saved in revenue gets added to the bottom line. So you end up saving a lot more. Thinking through that a little smarter made me realize that I could increase my prices 10 to 15% and see like a 25 to 30% increase in my bottom line, which allowed me to hire more people and do some of the things. So having some price and elasticity exercises about how much we could raise our products before impacting our conversions. And then just the whole how we attracted and acquired customers, we turned that on its head as well. We wanted to, Dan Kennedy says you can only grow your revenue by 3 ways, right? It's by getting more customers to buy more frequently and getting those customers to spend more each time they bought. And so we kind of thought through maximizing that in itself. And then the other thing we did more operationally is just had processes and systems in place. We kind of stress tested it. And I think you do something similar by removing ourselves removing our accessibility and just seeing if the shit tanks or not is something that we did unintentionally because we had a kid, but it ended up working out where the business survived based on the systems we put in place.
Yeah, babies, best stress test ever. Oh, we've had a couple of clients definitely go through that stress test. And so, and relating this to service-based businesses, just because a lot of our, obviously our clients, if you're running a digital agency, you're selling services more than anything. It's one, there's that calculus of like top line versus bottom line, right? Or gross profit. The thing to keep in mind though is like fixed versus variable expenses, which I think for a lot of our owners, especially when you're in a service-based business, it's kind of like, oh, we increase our pricing, and so therefore like expenses just get real out of whack. And variable gets real variable. So it's like, oh, we have 3 more clients, we are gonna hire 3 more people. Obviously that's an exaggeration, but right, so it's the idea of like, how do you really keep a pulse on what the expenses look like, so that you're understanding when you actually need to hire that next person. And I think that's really crucial, because if not, you can sometimes increase pricing or increase revenue, and then if the expenses are higher, you're like, your profitability goes to shit, right?
Correct.
So, and I'm curious to also know, like, when were you starting to make those hiring decisions? Like, once you started looking at your numbers in a much more calculated way.
Yeah, I started really nerding out. So for warehousing and like fulfillment is a big piece, right? Like delivery of product after you get the customer in, like you want to make sure they have the best experience. So there's no buyer's remorse, and you get them to come back and spend more and go through their hierarchy of your products. So for us, one big thing that we started doing was we created KPIs around how much customers one like employee could handle. And so we created KPIs around how many products one person could fulfill in the warehouse and how long it takes to fulfill this product. And then mathematically, we knew that, all right, when orders got to this point, we needed to start preparing for another employee. The other thing we did was we hired before we got there. So we hired now so that when we got there, we wouldn't break. And so we were thinking like quarterly, we created out an annual goal and had quarterly goals around that. And we were trying to hire in this quarter what we thought we would need for next quarter based on how our demand was. And we just kind of mathematically looked at how much money was going into marketing, what that spit out on the back end, and what kind of demand and stress that would create operationally. And we tried to stay ahead of that because we didn't want to break again. What I forgot to mention is that we were 2 months away. We kind of came to a halt and stop. We were doing about 20K a month in that kind of stop, just barely revenue trickling in. We put these systems in place, got our margins up to north of 40%. And then we got back to 6 figures within about 4 months since that breaking point. So we like quickly like ramped back up without breaking. So it was an important part of us was staying at least a quarter ahead with our hiring decisions. Yeah.
Absolutely. And I mean, basically you were doing like utilization and resource forecasting. So to really be able to make,
that's what I meant to say. Yep, that sounds like it. Yep.
to be able to make those decisions, because a lot of the times it's like, oh, when do we hire? I don't know. We kind of feel like our pipeline is going to burst, right? But it's not quantifiable, and so really having not only quantifying it but staying a quarter ahead allows you to train the people, right? Whether it's warehouse or customer service or whatnot, so that when the demand is there, they're already trained up. So that I think is very smart.
The other thing that we did that helped out a lot with scaling, because we have seasonality in our business, is we built a part-time on-demand workforce. So we had people, instead of dependent on like, let's say 2 people to constantly fulfill our warehouse, we would have like 6 part-time folks that did a lot of good things for us. And we did the same with like marketing. We essentially hired people who are already doing this in a full-time capacity at corporate, and we would just get a couple of hours of them after hours to deliver on some of this stuff. So that allowed us to get people inexpensively with a ton of experience, and we got to pull on them as we needed more of them. So moving into like Q4, when we needed a lot of creativity around design or product development ideas, we got more of them. But in the summers when things were slow, we could easily scale down our costs and expenses, and they wouldn't feel some type of way because they were already fully gainfully employed. And we did that with warehouse as well, where instead of filling orders throughout the day, we got these people who had other jobs, and this was supplemental income, and they would report to our warehouse manager, and they would come in after hours, so between 2 p.m. and 8 p.m. to work. So that allows us to really scale up and scale down based on our needs without negatively impacting our operational costs.
Yeah, so kind of creating a flex team. Alex?
Yeah, can I ask a question? I know this is about selling the business, but this is super real to me right now because I have basically a fully flex team, and that's like 20 people. So I do video production, so it's producers, editors, and copywriters. But we're like looking to make the decision to bring, and I have one full-time person who's our like head of ops. So just like you were, that was like the first real hire we made. But we're looking at potentially hiring some of these people, some of our producers full-time, because they're kind of like, they're account managers, producers, customer, they do like this whole, they run the projects. I was running the numbers this morning. I was basically building out the business case. Financially, it actually doesn't help us that much to hire them full-time. I think the reason that we're looking for full-time is like people who they're going to be more committed to getting really good at what they do because it is a specialty. Like it's like a specialty skill. So like that's kind of the reason for hiring versus like cost structure. My concern, and when I think about like selling the business potentially, is what's kind of cool if you have a fully part-time, everyone's part-time, because that's so interchangeable, right? There's like so little operational risk versus someone comes in full-time, they're now handling, 30% of your projects and then they leave. Where's that kind of fill-in space come from? Our plan is to maintain, just like continue to have a bunch of people who are kind of trained on our process, because the film world is full of freelancers anyway. So like there's some way to kind of maintain that extra capacity without having to pay people. But I guess maybe I'm answering my questions as I say them. But I guess it's like from an acquisition standpoint, is there either model that's more attractive? Like is it more attractive to have like this model where like you can kind of just bring in anyone and train them and then they're good, versus like having a kind of more core team?
And then to piggyback on Alex's question from an acquisition standpoint, also, is there something to having a little bit of a hybrid where, like in Alex's point, if you have two people that are fully trained up, is that sort of a sexy proposition that they can train other people? Because when you hire, that's kind of part of the transfer of assets, like that internal knowledge or tribal knowledge that comes with those full-time people.
Yeah, which leads to like the second bucket that we planned on talking about, which we could get into now. This is a perfect segue. It's essentially strategic value, and it depends. So there's no right or wrong answer. It's situational. So strategic value is essentially, what does your company do well that in the hands of an acquirer, usually someone bigger, they would have uniqueness or unique value to that they can deploy across their brand. So in their hands, it's worth more than it is to you. An example of this may be if you do video production for e-com brands, and the secret strategy for what you do is maybe your editing process. You may be super valuable to a direct response paid media agency that has 100 e-commerce clients, because they're usually having to outsource the video production and creative process, or each of their individual clients are responsible for going out and creating their own content, and that heavily dictates the performance that they're able to generate. So strategic value is that. So if you start thinking backwards, like what we're doing here, who would this be important to? Who would this be valuable to? And creating that as your North Star when you're serious about exiting, and thinking, does this hire or fire make me more valuable or less valuable to that person? So if that role that you're going to hire is an essential part of your magic, and that magic will be valuable to someone else, then maybe it makes more sense now to bring it in-house, because that will maximize your exit later. But if this is something that a strategic buyer would not have much value for, and they probably have this already in their departments or in their company, then it may not make sense. So you gotta, at some point, you have to start thinking, not only does it serve the business now, but how does it serve the business in the potential acquisition?
Mhm. Cool. Yeah, that makes sense. I think I'm kind of thinking like, yeah, in the world that we do this in, like no one, we're in a unique kind of niche, which is like it's we make videos for equity crowdfunding brand like launches. So we have this pretty powerful video. No one does content in the space. We're the only ones. Everyone else outsources it to non-specialized video production companies. So like, because content's really hard to scale, right? So we've kind of figured out a way to do that to some degree. We're kind of maturing right now. And
Nice.
I don't think anyone else, like the companies that would acquire us don't have these capabilities necessarily, or at least some of them. Like maybe they could like break off pieces of what some of these hires jobs would be, but they couldn't do the whole thing, I think. Yeah. Okay, cool. Thank you.
So yeah, these two components of like strategic value and transferability play hand in hand. So if having this in your company will make you more desirable and transferable, then it makes sense. But you know, like if the asset that's generating the revenue or the asset that's creating the uniqueness does not go with the company, then it's not a transferable asset. So like, and not only think about, so in your specific scenario, thanks for more clarity, you could think about what other creative firms are in this space, larger or similar, that may want to add this component to their business. You may think about what other crowdfunded platforms like Indiegogo, you know, fill in the blank, what crowdfunded platforms may want to add the creative component to what they're doing. And I know there are crowdfunded agencies that help put the whole piece together that may be recommended you. You may think about them, like, is this something that they may want to bring in-house to add more value? So there's like a couple of buckets of people just off the top of my head that, you know, may see what you're doing pretty interesting.
And we actually they all use us right now. The platforms use us directly, the agencies use us directly. So we're kind of, it's an interesting time where like our name is getting fairly known because literally no one else is doing it. So it's kind of, but
Solid.
yeah, it's interesting. Okay, cool. Thank you.
And a great way to start transitioning that relationship is to do a strategic partnership. So oftentimes what happens is if a strategic partner, like the ones you're talking about, you're like, man, in 2 years, I'd love to kind of push this thing and then get acquired. What typically happens is they would form a strategic partnership and start working together. Like you would essentially almost like white label the service for them or something like that, where they start realizing the value of what you're doing so much to the point where it makes sense for them to just think about acquiring you versus starting this skill set up. And larger companies usually are bad at being founders. They don't like starting things from scratch. They usually acquire to save time and skill sets. They acquire like the expertise, acquire your client book, and just save time. Like I always talk about Amazon and Whole Foods. It's a relevant recent example. They acquired Whole Foods and they overpaid, but the strategic value is there. And they wanted to acquire Whole Foods because they wanted to get into the grocery delivery business. And by doing so, when COVID came around, they already had everything set up to start delivering on it. If they would have had to start a grocery delivery business from scratch, set up supply chain, interview vendors, set up distribution centers, it would have taken them years to be able to do that. So it's much better for bigger companies to acquire an asset that already has this stuff figured out, because when they start making money from day one versus wasting money from day one, and they can move fast to take advantage of an opportunity.
How are you?
What's up, Ryan?
I muted Rom. I think he was walking around the office for a second and ran into somebody.
It's all good. But that's the last part of what I wanted to say. Just to, once you figure out what a strategic partnership may look like, how to start setting up the foundations for being attractive to a buyer.
And Gamal, how do you go about finding brokers? I know that's something that we had talked about, or buyers, right? Like whether it's a broker, whether it's a buyer, like what are the differences? Like who's out there buying these days? Like VC firms are getting into the buy, right? Like there's all sorts of potential buyers out there. What does the landscape look like? In the next 5 minutes, go.
Right.
Which could be like a total, like month-long conversation.
Yeah, that's the important part. But it piggybacks off of what we've already been talking about. I think a good exercise to do is to come up with a buyer persona, just like how you come up with a customer persona. So, like business owner, this size company, this amount of employees, et cetera, is the type of customer. So when you see them, you can identify them. I think it's the same thing with buyers. You don't want to specifically say like these two companies are what would buy me, but the persona of someone like this would be an ideal acquirer for me. And then once you have a good idea of what that is, it becomes easier to, like, when you see these people pop up, to put them in a database, just a Google sheet of, hey, this type of person looks cool. Or for you to identify a business broker or an investment banker who has done transactions of your size and scope with these type of people. So for us, the value that we're building is we were building a really profitable direct-to-consumer community. And people who we thought we could be valuable to were people who had traditionally sold in retail to our consumer base, or people who sold on Amazon to our consumer base, but had not yet done direct-to-consumer. And we found a business broker who had recent success with selling companies of our size and to the type of buyer that we were going to sell to. So when you're thinking about selecting a broker or going directly, usually if you don't have experience with M&A, you should work with a broker, because one, they help you package your business together better to seem more attractive and more valuable. And then the second piece is when buyers, when I was in M&A, when we would directly reach out to companies without a broker or an investment banker, internally we would kind of say, yeah, we found an off-market deal. And what that really said was, we're dealing with an unsophisticated buyer. This person does not have a lot of experience doing that. So there's some things that we can get away with that are going to be not normal for us, but because they haven't had the experience, we can get away with a little more. And a big piece of that is understanding what your valuation is. So a broker will help you realize that, the tax laws are set up for entrepreneurs. Usually we try to look at how we can minimize our taxable income with our business, like write-offs and things. If we buy a car, we invest in a computer, we build out our office space, we want to reduce our profit. But when you go to sell, if you hand over your internal financials, you're leaving a ton of money on the table. So the tax laws also set up for you to add back expenses. So your salary, let's say you make 100 grand a year in profit, your business, and you're getting a 6x multiple on your business. So we're forecasting that over the next 6 years, you'll make 600 grand. So I'll pay you that one time for you to walk away from your business, and you can do whatever you want with it. Well, in reality, your $100,000 business probably has, let's say, a $50,000 salary. You're probably paying 401k or benefits. You're probably writing off your car, your automobile. You may have another $100,000 in there that you've been writing off. So really, you have a $200,000 business adjusted with a 6x multiple. So instead of paying 600 grand, a broker will help you position your company to really be worth 1.2 million. So that's one really important thing. And then the second piece is they help move the process along. Selling your business could take so much time and energy. When we went to market, we had over 200 people interested in learning more about our business in the first week. I don't have all that damn time to be talking to 200 people. So this person played like a buffer or a quarterback to fine tune that to like a realistic 10 to 20 people who were serious. And then he got me involved when it was needed. So, that process, a lot of people mess up because they take their foot off the gas for the next couple of weeks or months, and your sale may or may not happen. And then you come back to this business who's been on like a downward spiral. So those are kind of the important things to think about, like identifying a buyer, why you should select a broker or investment banker, and some of the benefits.
Sorry, can I jump in with a question? So the way that our business, we have this kind of one side of it. We have a whole other side that's like much more boutique traditional production, less sellable in my opinion. How important is it to like have everything like fully legally, financially distinct, versus like we keep good numbers, like we have it all, it's all in one QuickBooks, but we like have distinctions that help us figure out what are all the costs and profits for one side of the business and the other. But it's not like legally distinct, and it's not like there's not two QuickBooks or something. How important do you think that is to keep it all separate versus like, you know, once you get going in the sale, like you can kind of build it out to show what the reality is, if that makes sense?
It's super important. So the other buckets that we never talked about was documentation and risk. And those are like red flags, documentation issues, red flag risk, because what they don't want to do is think that you're worth 1.2 million in this example, pay you that. And then when you start operating the business, they realize the expenses are more because some of the how you documented in your QuickBooks wasn't entirely accurate, or the revenue you're generating from this thing was not entirely so because it was really from the other part of the business that you didn't think was transferable. So having clarity around that earlier is better. Even if you don't separate the entities, having your accountants either set them up as a department and have real good methodology around how to explain how they separate the cost and revenue is important too.
Mm-hmm.
Yeah, super important though.
And to go off of that, Gamal, like, can one be a subsidiary of the other and then you just kind of the subsidiary, or however that looks? Because I know people who all the time, right? They're like, okay, umbrella company or holding company or whatever, here's the brands. They don't necessarily have to be particular companies or entities that are different. They just belong to the holding company or their DBAs, but then the books are separate.
Correct. That's a good way to do it. Just, it could be considered a department within your company and you're offshore in a department, or it could just be DBAs or subsidiaries. The main thing is just the allocation of resources and revenue. So for example, if you, an adjustment may need to happen. Like if you have one subscription to ClickFunnels, for example, and it's kind of spread across all entities, you just want to make sure that you have a per entity or per department cost allocation for the things that are being shared across. So like the shared services piece, or if your operations person is working across both departments, you want to have some allocation of what that may cost to replace her if he or she, if you just sell the department or the entity. That's the main thing. Or if revenue is being like cross-sold, that kind of thing, you just want to make sure there's clarity or at least an explanation about how that works.
And then, Gamal, when it comes to getting higher valuations, for your sale, right? One of the things that I have heard time and time again, and I would love your sort of point of view on this, is people should actually sell sooner than they think, because your valuation is greater in terms of multiple when you're having a higher growth rate as opposed to a higher revenue. Thoughts on that? Just in terms of like the sales cycle and all that jazz.
Yeah, there's definitely inflection points, which is at certain parts in either growth or revenue, your multiples change. And so a hockey stick curve is always great because you can sell the future, and you can sell trajectory. So a person I'm helping right now, they have great growth and they have an offer on their business now. And it's essentially of 2020 projections. So it's great because they're moving up and they're essentially getting paid on half of the year that hasn't even happened yet. And the good thing about projections is you can make them as friendly as you want, right? It's like not being proven. So that is a really good thing to do. But then also, you have to know as a founder that if you think that you're setting foundations for things that would amount or come to fruition a little bit later, you got to make a choice on whether to take like the guaranteed projection now, or if you push it down, push the sale a little bit further along, if you think that in a year or two from now, you'll be in a much better place. So it's up to you.
Cool. And what are other inflection points that I mean, because you mentioned like there's various inflection points. What are other ones when people are thinking about making a sale?
Yeah, especially for like the agency side, a lot of the service-based businesses and agency clients, the acquisitions are more about acquiring client base or client book. Like if an agency wanted to get an offering creatives for crowdfunding, instead of launching the department, they would buy it. So a lot of the inflection points there are like total number of clients or revenue, total revenue numbers. I know like $250,000, $500,000, $1 million, and 5 million are good inflection points. And what that means are like certain M&A departments, they have minimum check sizes that they have to cut, or they have max check sizes that they can cut. And with each size of growth, you become more attractive to new people, or you become unacquirable for some people. So understanding when you research your industry and you see the M&A, usually they will say like the size of the companies. You can start to get a gist for, I think I'll be attractive to this type of person. And here are the check sizes that they typically acquire at. For example, Procter & Gamble, you have to be a minimum of $20 million. But the longer you go past that, like to $100 million, it doesn't really serve you any purpose. So the sooner you hit $20 million, or right after you hit $20 million, it is, if you want to be acquired by Procter & Gamble, the most ideal time to position them, because that's the time you get the best bang for your buck. So understanding that is important. And unfortunately, I don't know what those are for your industries, but if you start Googling articles, they typically talk about it.
Okay, cool. Any other questions that we have?
I have a question about some of the red flags that you mentioned, documentation red flags. Can you give some examples of red flags that buyers would be looking for in a sale?
Yes. So a couple of red flags are, a big one is if they're like partnership disagreements, like if you started with a partner and they're no longer with them, but they own this, like they are on the cap table and they own a percentage of your company. Having that not clear on, do you have the ability to sell the business, or do you have the ability to negotiate the terms of the sale? That's a big one. Whether you have any pending or past legal issues, either with customers or the government, like you have a lien on taxes or whatever, that can be weird to buyers too, because they're not sure what trouble or liabilities are going to acquire. Those are the big ones. And then documentation, those are the big ones with risk. Documentation is also more so around how clean your books are. Do you have processes in place to generate the revenue you generate? Do you have contracts in place with the people who you work with? Are there NDAs around like sensitive information and proprietary processes? Back to risk also, there's risk around like marketing risk, product risk. And so that's essentially, marketing risk is, do you depend on only one channel or one source to generate marketing or generate revenue for your company? And if that goes away, will your company come to a halt? Which you missed the example, but earlier I was sharing how we were doing 6 figures a month, solely dependent on Facebook ads, and I lost my account and my business came to a halt, right? That's a risk. Product risk, does most of your revenue come from one product? And that may not be an issue if there are multiple ways for you to deliver that. If it's digital or service-based, that's cool. But if you depend on other parts or other companies to help you deliver that product, then they start taking a look at that. Like if you have done for you services or done with you services where you depend or rely on like white label providers to help you deliver the product to your customers, well, do you have backups for that, right? Do you have a backup copywriter or a backup content producer that if that person, like if 90% of your revenue comes from this thing, and a lot of the thing that you sell relies on having this copywriter that you outsource, well, do you have a backup copywriter if that one suddenly isn't available? So thinking about those types of things, like what things could prevent you from generating revenue and growing at the scale that you have been, and putting contingency plans in place in case something happens to your plan A.
Thank you.
Do, do you
Go for it, Alex.
do you typically, I mean, who kind of broaches the conversation of acquisition? Is that something that like entrepreneurs should be proactive about, or it's more of like, the companies you're kind of set up and you're kind of just waiting for them to say it?
Yeah, it's a weird dating game, right? It's
Yeah.
like, I think you could get valuable so it's better if they approach you,
Right.
for sure. But you kind of need to get on their radar. So that's what I was saying, by identifying who an ideal acquirer may be. We talked about a couple of examples in your case, and reaching out and just letting them know what you're doing, and starting a strategic partnership or an alliance with them is a great way to stay on their radar. So, for example, you may research agencies or a crowdfunding platform and see that they've made recent acquisitions, or if the executives usually go on and make announcements, especially if they're publicly traded or they're heavily funded, like VC backed. They will say like, here's what we're looking for this year. We want to grow in these areas, or we want to do more of this year, because they're actively raising money or they're publicly traded. They have to disclose that. So if you can position your brand as an option to help them achieve that and do that easier, faster, better with the partnership team, that's great. And so a good thing to say is, when you're talking with these companies, is just say, hey, we are positioning ourselves for growth because ideally we'd like to get acquired over the next couple of years, and we're doing the things that need to be done so that we are acquirable in the next 2 years. So this partnership will really allow us to grow fast in this direction. And you just start putting the bug out there and letting people know that that's something on your radar, and they'll run it up the chain to their M&A department.
Cool. Yeah, that makes sense. Just like dropping hints, just, so that they know that that's a thing you're interested in at the very least.
Correct.
Not kind of pushing it.
Correct. And they usually have a separate M&A department than what's going to be, I would imagine, like the partnership or sales department. So this person may not necessarily even know that, but once you start talking about that, they'll be able to kind of relay that back to their M&A partner.
Mm-hmm.
Yeah, or even a good question also that I've heard people say is, hey, I'd love to speak to the person involved in M&A, and just say, hey, like, for example, I'll give you a real example. So we wanted to get acquired by a certain type of brand. And when I met with the CEO, I said, hey, we're building this thing. Here's our value prop, which I knew was something that was on their long-term horizon. And in the next 2 years, I would love to get acquired by someone who looks like the profile of you. So what type of things do you look for when you're making acquisition decisions? And we just started having that conversation just to get on the radar. It wasn't necessarily an ask, but it let both of us know if we'd be a good fit potentially in the future. And having those similar types of conversations helped.
Did you have that when you were already like kind of established with them, or like it was like a kind of conversation was happening, or like early on you were like building the partnership and you were kind of saying that?
I would say it works best when you have an existing relationship. That person ended up not being the person who acquired us, but it just got my practice up to realize what was important for us to build. So that was most helpful for helping me identify how to build more value in my brand.
Cool. Thank you.
And Gamal, when there's an acquisition happening, right? Sometimes people can think of what are the assets of the business that are being acquired, right? So one can be like average length of contracts, right? Like when we think about the book of business, it might be, or repeat customer base. You had mentioned a community, right? A team, infrastructure that has been put in place, code, right? That's really important to a particular business. So when we think about these assets, like what do you think, especially in a service-based business where everything is so intangible, like what are the assets that are being looked at in sort of evaluation of an intangible business or creative business?
Great question. So a lot of those center around strategic value as well. And so thinking about what other acquirers are struggling with in your industry. So it may be that you have a unique model to acquire customers well below what's average for your industry, right? And so like lead generation may be an opportunity for someone to acquire you and then upsell or cross-sell your products into their suite of services. So that could be one thing. It could be that you have a big one is that you have a fucking great domain name, and that by acquiring you, they would have they would have the ability to now use that domain name to build more industry domain or whatever. So domain name, social media presence, email list. If you just maybe you have 100,000 of their ideal customers in your list, and you have a 40% open rate on the newsletters that you send out once a month, that's freaking amazing. Think about how valuable that would be to someone in your industry when they're thinking about the average lifetime value of a customer. So there are a lot of intangible things that become very tangible in the eyes of strategic value.
Thank you.
The other one big one too is if you can have exclusive contracts with your customers, that is huge, because the only way, for example, if you have an agreement with some of these, let's say an agency, no, let's not say the agency, let's say you have an exclusive agreement with the crowdfunded platforms, and you get in contract that you are the exclusive for being able to work with them, which you do, sounds like. Think about how valuable that is to someone else who's trying to get in on there but can't. The only way to get into these people is through acquiring you. So your business may be worth $1 million on paper, but the strategic value of that relationship may be worth $5-10 million to someone. So you may get paid above and beyond what your numbers say, simply because that's the cheapest or only way they can get in with that company. So that's another example of a tangible asset that's very valuable.
Very cool. I think we have time for maybe one question, unless Gamal, you gotta go. I think 12:59, just watching the clock. And one more question. Jeremy, you've been quiet. Do you have a question?
No, I found it pretty informative. I've been taking some notes. So no, at the moment, I don't really have one. I'm not thinking about selling, but I'm finding it very interesting. So thank you.
All right, cool. Yeah, for sure.
Jeremy
Mo?
just said an interesting part too. The thing about not selling, I found that when I started thinking about selling, I made much better decisions as a business owner, because I was like, I had no accountability, or like I made the decisions essentially, my wife and I, or the two executives. But when I started thinking about how would this decision or indecision look to an outside investor, I started making smarter decisions for the business. And I ended up scaling back, working a lot less in my business. And my business actually ran more like a big business. And so it's an interesting concept. I would encourage you to think about putting this process in place sooner rather than later. And you would just see how much more it is enjoyable to start running your business when you're already thinking about selling it, because that extra layer of accountability is there.
Yeah, definitely noted. I should have said that a little differently. I'm always thinking about how my business looks from a buyer standpoint. You know, I have been for a couple of years now. I'm not happy with it, but your advice is very well taken, and it is in my brain and in my thought process of what would an exit strategy look like when I am making these decisions around it.
Sweet.
Very good point.
All right, cool. Itai, are you there? And if not, Alex or Samantha, if you guys have one more question. Thinking about it. Very cool. Itai.
No,
I saw you unmute yourself. Everyone's just taking notes.
Just and looking forward to reviewing the recording in more detail. Thank you.
Very cool. Gamal, is there advice that you wish you could give more often?
I think we covered it in just thinking about the accountability, like having a North Star with an exit in mind, even if you don't plan on doing it, and just making all your decisions to that. Because a very specific example is around hiring and firing. When I stopped thinking about like my current needs and more like what would this look like a year from now to a buyer, I start thinking more strategically about, should I really fire this person, or is this like a training issue? Or do we really need to bring on more? Or is this just a current stress capacity in which I can solve for this a different way. And it really just made me run a smarter business. And so I would just, reiterate, thinking about that and keeping it as your North Star. And strategic value is so important. Not only is thinking about strategic value for an acquisition, but think about strategically, what's your strategic value to your customers? And what things you can intentionally do unique to your competitors that in your hands or in your customers' hands, your business will be more valuable than your competitor's business would be in their hands. So thinking strategically about not only how is my business uniquely attractive to a buyer, but to our customers really helped me come up with unique positioning and pain points that allowed me to get customers to buy from me 46 times and allowed me to get like more than double the average repeat customer rate from our customers, which which then made us more attractive to buyers. But the core thought initially was, how can we be strategically valuable to our customers in a way that no other competition can be?
Yeah, I love that. Gamal, thank you so much for joining us and spending your Friday. Oh, Mark, you have a question. Okay.
Gamal, do you have anything that's like a 1-year exit checklist, like a high level roadmap of the process, but like in a checklist format?
No, but it sounds like I need to do that.
Cool.
Okay. And if you create it, if we could share it in our inner resources, that would be amazing because it would live there beyond other places that I'm sure Mark will be happy to talk to you about. Yeah, that would be super cool because I think that's something that at least high level, there's things that we often think about but aren't actually putting either pen to paper or aren't looking through from a quantifiable standpoint, right? Especially like when we think about, here's the 3 buckets, here's how you can think about each of the 3 buckets, here's the red flags of the 3 buckets, like, stop it, don't do that. I think that would be immensely valuable for people.
Yeah, I have that in the form of a presentation, what the risks are, the buckets that people look for, but not in a checklist. So that's interesting.
And then the checklist could become a scorecard.
Sweet.
Something that I've been learning over the past like year and a half or so, and kind of what you were saying, while like thinking about an acquisition just makes you run your business better. There's like moments where you just like start running your business more like a professional. And it's like, I found like when we hired our first employee, that was like a moment where I was like, okay, I gotta run like a professional. When we started, getting over capacity. And I think like thinking like an acquisition is like really a top level way to just like really, truly, get out of the, what is it, like the E-Myth, like, I forget what they call it, but it's like the artisan or something into the, entrepreneur.
From the technician to the visionary, I think it is, or entrepreneur.
Okay. Yeah. So you like pictures. This is a little thing here that you can screenshot and take a photo of. But this is the bucket of things that buyers look for. And then we go through and have more specifics about what that looks like. But I can definitely create a cheat sheet around this. I appreciate that idea, or a checklist around this.
Absolutely. We look forward to seeing it. Now you have accountability for it. Well, thank you so much, everybody, for joining us. Thank you, Gamal, for sharing your time and expertise.